All right. Hey, everyone. Welcome back. A lot of us are out there looking to put some money to work in the market, right? Let's say $1,000, and we want to target those juicy dividends.
Yeah, dividends,
Yeah.
always a popular topic.
Always a popular topic, especially when you get that passive income rolling in. So we're diving into this article today, and it claims to have found some no-brainer, high-yield REIT stocks.
No-brainer REITs.
Yeah, they're throwing out some big names, but as always, we got to see if they really live up to the hype, right?
Mm-hmm.
What do you think?
Well, I'm always a little skeptical when I hear no-brainer in the same sentence as investing, right? I mean, how many times have we seen those so-called can't-miss opportunities kind of go south pretty quickly?
Yeah.
Especially with REITs, they can be a bit more complex than they might appear at first glance. Definitely not all created equal.
That's a great point. And this article, it highlights 3 REITs specifically. So first up, we have Rexford Industrial, ticker symbol XR. And one thing that caught my eye was, just last quarter, they reported this impressive 39% rent increase on new leases.
Wow, 39%. That's pretty significant.
That's got to be a good sign, right? I mean, that suggests strong demand.
It definitely does suggest they have some pricing power. That's a positive. But here's the thing. Their stock price is actually down, like over 50% from its high.
Huh.
So is this a case of, a company with really solid fundamentals, maybe the stock price is just lagging behind? Or is there something else we need to be aware of, before we jump in and say, hey, 39% rent increase, let's go?
Yeah, that disconnect, between a company's performance and the stock price always makes me kind of like, what's going on here?
Mm.
If it seems too good to be true, you know the rap. Now, the article mentions that Rexford focuses exclusively on the industrial market in Southern California.
Mm-hmm.
And, I can see how that could be both a strength and a weakness, right?
Yeah, absolutely. I mean, focusing on a niche market can be a really smart strategy, especially if you can kind of like become the dominant player in that space.
Right.
And in Rexford's case, Southern California, major hub for logistics and warehousing, high barriers to entry, low vacancy rates. I mean, on the surface, it sounds great.
It does,
but that concentration can also become a risk. What if something happens that specifically impacts the Southern California economy? A natural disaster maybe, or a shift in trade patterns, who knows?
Yeah, you don't want to have all your eggs in one basket.
Exactly. If something like that happened, their entire business would be vulnerable.
So geographic concentration, definitely something to keep in mind. But even with that risk, Rexford is offering a 4.3% dividend yield. And they've been growing that dividend at an average rate of 13% per year for, the past decade.
13% per year consistently.
Yeah, that's what the article says.
Yeah, okay.
That has to be attractive to someone looking for, that passive income.
Oh, absolutely. That kind of dividend growth is, it's really impressive. And it's something that, long-term investors, those who are looking for that consistent stream of income, that would be very appealing to them because it means your income from those dividends is increasing year over year, really compounds your returns over time. But we also have to understand why they've been able to grow it so consistently.
Right.
Is this sustainable? Are they just borrowing money to fund those payouts? Or is it coming from, genuine earnings growth?
We need to look under the hood.
Exactly. These are the questions we need to be asking before we hit that buy button.
All right, so Rexford, maybe a bit of a mixed bag, strong potential, but some concentration risk. And like you said, got to dig into the sustainability of that dividend growth. Okay. The next REIT on our list is Realty Income, ticker symbol O. And this one is often called the, the Steady Eddie?
Oh, yeah. Realty Income, the Steady Eddie of REITs.
Of the REIT world, and it's the largest net lease REIT out there. So can you explain what a net lease is and why that makes Realty Income so steady?
Sure. So imagine you're renting a car, but you're also responsible for the gas, the insurance, and even the maintenance.
Okay.
That's kind of what a net lease is like for commercial properties.
Gotcha.
So the tenant, not the landlord, covers most of the operating expenses. And this creates a very predictable income stream for the landlord, which is why, net lease REITs like Realty Income are seen as, a bit lower risk. They're not going to have those wild swings in revenue based on, whatever's happening with operating costs.
So that predictability, it's like built into their DNA almost.
Pretty much.
We're talking about a company with over 15,400 properties in its portfolio, spanning a whole bunch of different sectors, even a presence in Europe. That's a lot of diversification.
Oh, yeah, a ton of diversification. They're not putting all their eggs in one basket geographically or in terms of the types of properties they own. So that definitely makes them more, I guess, resilient to economic downturns. They're like the tortoises in the race against the hare.
Slow and steady wins the race, right?
Exactly. Realty Income, they're not going to win any speed contests, but their approach, slow and steady, it served them well for decades.
Well, speaking of slow and steady, their dividend history is pretty impressive. They've been increasing it annually for 3 decades straight.
3 decades.
That's pretty remarkable in any market environment.
Yeah, it really is. It speaks to their consistency, their commitment to shareholder value.
Yep.
They're currently offering a 6% yield, which is, it's not bad. And when you factor in that dividend growth, historically, you're looking at a potential total return of around 10%, which is, pretty much in line with the long-term market average. Not too shabby.
Yeah. I mean, it might not be the most, exciting investment out there, but it definitely seems like a solid choice for someone who's prioritizing stability and consistent income.
Absolutely.
Okay, so before we move on to the last REIT, I'm curious, even with a company like Realty Income, there's got to be some risks, right? Every investment has some level of risk. So what should investors be aware of here?
Oh, for sure. I mean, even the most stable companies, they have vulnerabilities. With Realty Income, one thing to think about is interest rates. Because they own so much real estate, they often carry a significant amount of debt. So when interest rates go up, their borrowing costs increase, which can impact their profitability and potentially even limit their ability to keep increasing those dividends.
That makes sense. Interest rates, a
Yeah.
big deal for any company that relies on debt financing. Right. So even with Realty Income seemingly rock solid, still some factors to consider. Now for our last REIT, EPR Properties, ticker symbol EPR. The article kind of frames this one as the comeback kid, right? A more maybe exciting but higher risk option.
Yeah, comeback kid. I like that.
Yeah.
And there's a reason for that. EPR, they focus on what are called experiential properties.
Yeah.
And as you can imagine, those were hit hard during the pandemic. Movie theaters, amusement parks, ski resorts, places people go for entertainment and leisure activities.
Right.
They actually even had to suspend their dividend for a while, which is, never a good sign.
Yeah, not a good sign at all. But it sounds like they're back in the game now. And the article highlights a couple of key narratives at play. First, most of their tenants are in much better shape post-pandemic.
Yeah.
Right? Which means improved rent coverage. Those tenants are more likely to make their rent payments on time.
Right. That's crucial for a REIT.
Absolutely. And then second, EPR is strategically reducing their exposure to movie theaters, which are still, kind of struggling to recover.
Yeah, that move away from movie theaters, that's strategic. Shows they're adapting. They're trying to mitigate risk, which is smart. But, the fact that they had to suspend their dividend in the first place, that's a red flag. It raises questions about how resilient their business model really is.
Yeah. Did they learn their lesson? Had
Yeah.
they truly diversified their portfolio enough to withstand future shocks? Who knows? But on the flip side, with a 7.6% dividend yield.
Yeah. Ooh, 7.6.
EPR is definitely, catching people's attention.
Plates in my eye.
Yeah. But we also have to acknowledge that the dividend is still below pre-pandemic levels.
Right. Still some ground to recover there. But when we look at their funds from operations, or FFO, essentially, the cash flow generated by a REIT, their payout ratio was 66% last quarter.
66. Okay.
So that means they're paying out 66% of their FFO in dividends, leaves them with a decent cushion to potentially increase that dividend in the future.
Oh, interesting. So even though the current yield is high, you're saying there's still room for growth.
Potentially, yeah. And that's what a lot of income-focused investors are looking for. A dividend that's not just high, but also sustainable, has room to grow over time.
Okay, so EPR, maybe a bit of a wild card here. High yield, potential for growth, but still recovering from the pandemic and, carrying some baggage from that dividend suspension.
Yeah.
Definitely seems more speculative compared to the other two we've talked about. All right, before we jump into the next part of our deep dive, any final thoughts on EPR or the article's claim that these are all no-brainer investments?
Well, calling any investment a no-brainer, I think that's a little misleading. As we've seen, each of these REITs has its own set of, risks and potential rewards. EPR in particular, it really highlights how even those seemingly stable investments can be vulnerable to unexpected events, The pandemic, who could have predicted that? And while a high yield is always tempting, it's important to look beyond the headlines, understand the fundamentals. What's driving that yield? Is it sustainable? What are the potential risks that could impact the company's performance?
You got to ask those tough questions.
You do. Those are the questions we need to be asking before we invest our hard-earned money.
Excellent point. Due diligence is key, especially when you're dealing with a smaller amount of capital, like our listeners' $1,000.
All right, let's take a quick break and then come back to explore these REITs in more detail. We'll look at their financials, analyze their competitive landscape, and discuss how they might fit into a portfolio designed for someone who's looking to invest that $1,000 wisely.
So, we've gotten a taste of these three REITs, and what's interesting is how they each appeal to, well, a different kind of investor, right? Mm-hmm. It's not as simple as the article made it seem. Like, just pick one of these three and you're good to go.
It's not a one-size-fits-all situation.
Not at all. It's more like picking the right tool for the job. Yeah, I like that analogy. It's about finding the REIT that aligns best with your own, goals and your risk tolerance, especially when you're starting with a smaller amount of capital like our listeners' $1,000. So let's break it down, right? If you're someone who's drawn to that consistent, growing income, Rexford, with their track record of those dividend increases, that might seem like a good fit. But we also talked about their geographic concentration risk. Is that something, a $1,000 investor should be overly concerned about?
That's the $1 million question, or the $1,000 question in this case.
Right. Yeah.
It really comes down to your overall portfolio and how much risk you're comfortable taking. I mean, if this $1,000 is your entire investment portfolio, then yeah, concentrating it all in a REIT that's exposed to a single geographic area, that might not be the wisest move. But if this is just one piece of a larger, more diversified portfolio, then that concentration risk might be less of a concern.
So diversification is key, even with a smaller investment. You're not suggesting someone put their entire $1,000 into Rexford?
No. Not unless they have a very, very high risk tolerance and a deep understanding of the Southern California industrial market.
Right.
Diversification is about spreading your risk across different asset classes, different sectors, geographies, the whole 9 yards. It's like that old saying, don't put all your eggs in one basket.
Exactly. It's about balancing those potential rewards with the inherent risks that come with any investment. So if Rexford is the kind of the growth play with their focus on dividend increases, where does Realty Income fit into all of this? They seem to be more on the the slow and steady side of the spectrum.
Yeah, that's a good way to put it. Realty Income, they're like the marathon runner of REITs. They're not looking for quick sprints. They're in it for the long haul. And their massive portfolio, over 15,000 properties, spread across all those different sectors and geographies, that makes them, well, a relatively safe bet. Now, they're not immune to economic downturns, of course, but they're definitely well-positioned to weather storms better than a lot of other REITs out there.
And their 3-decade streak of annual dividend increases definitely speaks to that stability and commitment to shareholders. But, I'm curious, for our listener who's looking to put $1,000 to work, is that 6% yield that Realty Income offers, is that really enough to get excited about? Especially considering that their dividend growth hasn't been, well, historically it hasn't been huge.
That's a fair point. In today's market, a 6% yield might not seem like much compared to some other investments out there. But remember, yield is only one part of the equation. The total return, which includes the dividend yield and any stock price appreciation, that's what ultimately matters. And Realty Income, they've historically delivered total returns in that 8% to 10% range, which is, it's pretty respectable, right in line with the broader market.
Yeah. They're not going to make you rich overnight, but they're probably not going to keep you up at night worrying either. Which brings us to EPR Properties, right?
EPR.
This one feels like the, high risk, high reward option, given their focus on those experiential properties and the fact that their dividend is still kind of recovering.
Yeah.
Is this something a $1,000 investor should even be considering?
Well, it depends, right? If our listener is a very, very conservative investor, someone who prioritizes stability and predictability above all else, then EPR is probably not the best fit. But if they're willing to take on a little more risk for the potential of higher returns, then EPR might be worth a closer look. Remember, they're currently yielding 7.6%,
wow,
which is significantly higher than both Rexford and Realty Income.
Yeah.
And while their dividend is still below pre-pandemic levels, their payout ratio suggests they do have some room to increase it in the future.
So you're saying EPR is more of a speculative play. You're kind of betting that the experiential sector will continue to recover, that they'll keep diversifying away from those movie theaters, and that they'll, keep increasing that dividend.
You got it. There are definitely more ifs associated with EPR than with the other two. But for someone who's comfortable with a little more uncertainty and who's really attracted to that higher yield potential, EPR could be, an interesting addition to a diversified portfolio.
All right, so I think we've done a pretty good job of outlining the pros and cons of each of these REITs. But this is the deep dive, and I feel like we need to go a little deeper, especially for our listener who's, eager to put that $1,000 to work. What else should they be considering before making a decision?
Yeah, this is where the real work begins.
Right.
Before investing in any of these REITs, or any investment for that matter, it's crucial to do your own due diligence. Don't just take our word for it. Don't take the article's word for it. Look beyond the headlines. Really understand what's driving each company's performance.
So where should our listeners start? What kind of information should they be looking for?
Well, first, I would recommend diving into each company's financial statements. Look at their revenue, earnings growth over time. Are they increasing consistently? Are there any red flags popping up? Check their debt levels. Are they taking on too much debt to fund their operations or acquisitions? And look into their future prospects. Are they expanding into new markets? Are they developing new and innovative products or services? Really understanding the financial health of each REIT is essential before making that investment decision.
That makes sense. Don't just rely on, the rosy picture painted in an article or a company's marketing materials, right?
Right.
Get into the nitty-gritty, the details, and see what the numbers actually tell you. But financials are only one piece of the puzzle. What else? What else should our listener be thinking about?
Oh, absolutely. Don't overlook the competitive landscape. Who are these REITs competing with? Are they the dominant player in their market, or are they facing really stiff competition? What are their competitive advantages? Do they have a unique business model, a strong brand, a loyal customer base? Understanding the competitive dynamics of each REIT's industry, that's crucial for assessing their long-term prospects.
So it sounds like we're talking about analyzing both the internal factors, like their financials, their management team, and the external factors, like the competition, the market trends, right? Painting that holistic picture of each REIT.
Exactly. And don't forget about the broader economic environment, too. Are interest rates rising or falling? What's happening in the real estate market? These macroeconomic factors, they can have a big impact on REIT performance. So it's important to be aware of that bigger picture as well.
Okay. So our listener, they've analyzed the financials, they've assessed the competition, they've thought about the macroeconomic environment. What's next? How do they actually decide which REIT is the best fit for their $1,000 investment?
This is where it gets really interesting.
Okay.
Now they need to think about how each REIT aligns with their individual goals and risk tolerance, right? Are they primarily seeking income, or are they looking for capital appreciation? Are they comfortable with a higher level of risk for the potential of higher returns? Or do they prefer a more conservative approach?
It's really about matching the investment to the investor.
Exactly.
Not every investment is right for every person, even if it looks, fantastic on paper. So how would you advise our listener to think about their investment goals and their risk tolerance? What questions should they be asking themselves?
Well, here are a few key questions they can consider. What is their time horizon? Are they investing for the short term, long term, or somewhere in between? How much volatility are they comfortable with? Are they okay with their investment, going up and down in value? Or do they prefer something more stable and predictable? And maybe most importantly, what are they hoping to achieve with their investment? Are they saving for retirement, a down payment on a house, their children's education? Answering these questions will help them determine which REIT, if any, is really the right fit.
That's great advice. Be honest with yourself about what you're trying to achieve, how much risk you're really willing to take on. And remember, diversification is still important, even with a smaller investment. Even if our listener decides to put that entire $1,000 into one of these REITs, it's crucial to think about how that fits into their overall financial plan.
Absolutely. This $1,000 investment, it should be part of a larger strategy. And as they learn more about investing and gain experience, they can adjust their approach and their portfolio accordingly.
So it's a journey, not a destination.
Exactly.
Investing is an ongoing process of learning, adapting, and making informed decisions. Well, I think we've covered a lot of ground in this deep dive. We've analyzed the financials, assessed the competition, considered the macroeconomic environment, talked about the importance of aligning investments with individual goals and risk tolerance. Before we wrap up, any final thoughts for our listener who's ready to take that next step and actually invest their $1,000?
Yeah, I think we've given our listener a lot to digest here, right?
Well, I have to think about this article tried to make it seem so simple, but as we've seen, there's a lot more to it than just, oh, pick the REIT with the highest yield.
Yeah, exactly. And that's what's, potentially dangerous about those catchy headlines, those no-brainer claims. Because what's fascinating to me here is how each of these REITs reflects a different approach to investing. You've got like Rexford, the growth-oriented play, then there's Realty Income, that slow and steady option, and then there's EPR, the higher risk kind of turnaround story.
It's like choosing a path. Each one could potentially lead you to your destination, but the journey's going to be quite different.
Exactly. And the key, as always, is to choose the path that aligns with your individual needs, your preferences, your risk tolerance.
Right.
And for our listener who's starting with $1,000, that choice becomes even more, I think, crucial. They've got to make every dollar count.
Yeah, it's not just about picking a REIT. It's about making a smart investment that fits into their broader financial goals.
Yeah.
So before we send our listener off on their investing journey, any final words of wisdom? What's the one thing you want them to take away from this deep dive?
Well, the article called these REITs no-brainers, but as we've clearly seen, there's always more to the story.
Right.
Before you invest any amount of money, and especially a limited amount like $1,000, dig deeper, right? Understand each company's financials, their competitive landscape, the risks involved, and most importantly, consider how they fit into your overall investment goals, your risk tolerance, your whole financial picture.
I couldn't agree more. This deep dive is all about equipping you, our listener, with the knowledge, with the confidence to make those informed decisions. But remember, we're not giving financial advice here.
Always do your own research, consult with a financial advisor if needed, and make sure any investment you make aligns with your personal circumstances and your goals.
Absolutely. That's all for today's deep dive. We hope this journey into the world of REITs has been insightful and, empowering. Happy investing, everyone.